back upwards today. So just to open it off, do you think that some of these names that we're seeing popping today are some of the shorts covering their positions, where we're seeing these pops in growth from skills and other areas?
Yeah, probably. I mean, that's definitely got to be part of it. So I've been saying for the last couple of weeks that eventually you're going to find the bottom. I mean, this sell off in small cap growth and even mid cap growth has been unbelievably, more dramatic than I ever thought it could be. I don't think I gave enough credit to what the shorts could do if they really went all in on some of these stocks. And we haven't seen a lot of volume in the last couple of weeks, so you see stocks going down 4 or 5% every single day on light volume, which just makes me think there is just no buyers in the market, or at least there wasn't for the last 2, 3, 4 weeks. There just wasn't any big retail investors or funds willing to step in and try to catch that falling knife. But then what happens is you find a bottom. There's a lot of things that can start the bottom. I think so. I talked to a few big institutional guys yesterday, and they said that they were already starting to see some big call option buying in some of the most beaten down names, which is now I don't know if those particular funds or investors also had shorts on, because what I think some of these funds do, if they're smart, I mean, even though I hate the shorts and I think a lot of them are scumbags, I mean they still play this game very well, and they know who to pick on and when to pick on them. And picking on small cap stocks in between fourth quarter and first quarter earnings, when there's really no catalysts, is probably the best time to pick on these stocks. And then you also had a lot of these companies coming off their all-time highs in February. A lot of them were also issuing more stock. So they were, as those companies hit all-time highs, they raised capital to, continue their growth trajectory, since a lot of them are not profitable yet. So you have the dilution. You also have some insider selling. Valuations get frothy, and then you start to see a rotation out of small cap growth into value, into the recovery stocks. And it was just like the perfect storm for the shorts to come in and put pressure on these small caps at the same time that retail was probably chasing a lot of these companies, using up all of their margin. And retail has very weak hands. I mean, let's be honest. Retail investors are going to be the first ones to panic when their stocks start to fall. As these shorts put the pressure on and the stocks drop 15, 20%, a lot of retail investors are just, they might try to catch the falling knife for a week, and then they just give up and either sell their position, or they just ride it all the way down because they don't have any more capital to keep adding. Um, but at some point, those big shorts are going to want to cover their positions, especially before we get into earnings. Because when you see stocks like Skills and others that are down 50, 60, 70% from the all time highs, and you had a stock that was trading at 40 or 50 that's now in the low teens, that sets the bar pretty low going into earnings. And if they post, some of these companies post just decent numbers and decent guidance, or God forbid they actually raise guidance, that's where you start to see some pretty big gap ups and moves to the upside. And the shorts just made massive amounts of money, pressuring these stocks down. I don't think they want to risk those profits by being on the wrong side of a gap up. So I think that this bounce is a combination of the buyers coming back in, the shorts trying to cover, call option buying. So I hope yesterday felt like some pretty serious capitulation, just based on not just how far the stocks were down yesterday. I mean, a lot of small cap growth stocks that I own or track were down 8 to 12% yesterday. And the sentiment across Twitter and across stock twits and my emails and DMs was about as bitchy as I've seen it in a year. So that's a pretty good sentiment indicator. I mean, people were like literally ready to just wave the white flag, give up, go to cash. Like when you've absorbed a 30 or 40% downside, and it just feels like there's just, these stocks are going to, even though I know they're not going to zero,
Hmm.
for someone that's maybe a little bit less experienced, if they've never really seen a significant pullback, that thought starts to creep in their head, like, oh my God, these stocks are going to zero. Even though I'm down 50%, I'd rather just sell now, go to cash, salvage my capital, and then come back in when the coast is clear. like when a lot of people are thinking that way, it means you are at the bottom or very close to the bottom.
Got it.
So I'm curious. I'm curious to see if this rally holds today. I'm curious to see what we get tomorrow and Friday. I think that'll be a better sign as to whether this relief rally has any strength or not. I think it does. So I think yesterday was the bottom. I think this bounce is going to last a few days. Valuations on growth stocks got way too cheap in the last few days. And I think as we go into earnings season, you're going to see some strong numbers from some of these companies, and you're going to see guidance go up. And that's, that could be a nice catalyst for, for a 20, 30, 40% move higher in some of these
Hmm.
stocks.
I think that's what we're all hoping for. And real quick to all my listeners, so thank you for everyone who's joining us to be listening. I'm going to be asking several questions. These are questions, a lot of them from the audience. If you go to my page, you'll see that I posted a Google form. You can still go in there if you have some good questions. You can throw them in the Google form. Also, as always, thank you to all the listeners, Parrot, Max, Dylan, so many of you that are in here. Anybody that can share out this link with your audience, you could just go to the bottom, hit share, share it out as a tweet. That would be awesome. We would love to have more people in here. We're going to be running for probably about another 30, 35 minutes. So, Jonah, a couple of questions from the audience. And I thought that this one was a good one to start off with because it's more research oriented. And that was, what are some of the most important metrics that you look at to measure profitability of growth stocks? Besides the obvious net income, EBIT, NOPAT, what are some of the other metrics that you are gravitating towards? And that one's coming from at Geno Capital. So shout out to them.
Yeah, I mean, I think he just mentioned most of them that you'd want to look at. It depends on what types of growth stocks you're looking at. I mean, are you looking at the really early stage ones, or are you looking at more mature ones? I mean, if you're looking at earlier stage growth stocks, like let's just take DermTech for an example. I mean, DermTech is one that I did my write up back in, I think it was January, when the stock was in the high 30s. It rallied up into the 80s. A lot of people on Twitter, some of my followers were chasing DermTech up in the 60s, 70s, 80s. I was not. I think the problem is they saw that it was the biggest position in my portfolio. And since I had done so well year to date, they just wanted to copy my portfolio. But that meant that they were chasing some of those stocks at the all-time highs. And now they're down 50%. I'm down a little bit on DermTech. My cost basis is like 44 right now. So, I mean, I'm still losing money on DermTech, but I do feel bad for the people that have those much higher cost bases. I mean, they're way under. But yeah, I mean, DermTech is obviously trading at a very high price to sales multiple, but that's backward looking. I mean, even if you look at this year's price to sales multiple, I get it's going to look expensive, but you can't just look at it on an absolute basis. You have to look at it compared to its growth rate. And DermTech, in my opinion, has a chance to 3x sales this year. So last year's sales were just under 6 million, I believe, on DermTech. And this year, the analyst consensus are around 12 to 13. I think there's a chance that the company does more than that, somewhere between 18 or 20 million. But a lot of that's going to depend on, the reopening after the pandemic and the adoption from the dermatologists, and whether we get Luminate in this year or next year. So, I mean, there's obviously some factors there. But, a company like DermTech is probably not going to be profitable for at least a couple more years as they're trying to grow at these ridiculous rates. And, as they have new products that come to market, Luminate later this year, Carcinome next year. And if you look at the company's investor presentation, both of those products are expected to be much, much larger products than the current PLA and PLA plus,
Mhm.
which is what we've been talking about, which is for melanoma detection. So, companies like DermTech, I don't care about profitability yet. Like, I want them to grow as fast as they possibly can and roll out this product into as many dermatologist offices as possible and spend money on sales and marketing to educate the patients. So, EBITDA, net income, free cash flow are not numbers that I even look at. I couldn't even tell you what they are in DermTech because it's just such an irrelevant part of the story. If you're looking at like the semi-mature growth companies, let's call that the Twilios, the Rokus, CrowdStrikes, Cloudflare, right? Those Peloton, companies that are in that 20 to $60 billion market cap space. Those are companies they still have strong growth rates, but growth is obviously decelerating from maybe where it was a couple of years ago. So where they were growing at 70, 80%, maybe now they're growing at 30 or 40 or 50%. That's if you're gonna go through this period now of deceleration on the revenue side, you want to start to see those other numbers looking better. You want to see gross margins going up. You want to see EBITDA income, break even or not, but you at least want to see the EBITDA margin heading up, that income margin heading up. And even if they're not positive yet, you want to at least see them headed in the right direction. But, those aren't the companies that I own anymore. I do focus on these small cap growth companies. In most cases, they're not profitable. I guess the part that's really kind of caught me by surprise in the last couple of weeks is even the companies that are profitable have still gotten pounded, and that's just to me, when you have high retail ownership, you have a low float, because in the case of, like, let's take Futu or Upstart, where they're somewhat recent IPOs, you still have a big percentage of the stock that's owned by the founders, the early investors, other insiders, and then the rest of the stock seems like it's owned by retail. Like, those have been easy targets for the short sellers. So even though Futu and Upstart have incredible growth top line, but then they also have incredible, the other metrics look great, like the EBITDA margins, the net income margins. I mean, Upstart, net, I think they said that their contribution margin, they don't really, so gross margin on Upstart is around 83, 84%. The company doesn't really talk about gross margin. They talk about contribution margin, which I think was somewhere around 46%. And then I think their net income margin was somewhere in the high single digits. But obviously, that means they're still profitable, and they recently did a secondary offering to add some more cash to the balance sheet. But like, Futu's numbers are still unbelievable. I mean, we're talking 115 to 120% top line growth, 58% EBITDA margins, 47% net income margins. But yet they were still getting sold off in this recent pullback. And then yesterday they announced a debt offering, or 2 days ago they announced a debt offering. This is the one that kind of caught me by surprise. I think it's being misinterpreted by the street, though. And if I had more cash, I probably would have gone in this morning and bought more Futu at 130, because Futu is such a unique example of a company that really didn't need to raise more capital for the balance sheet, but wanted to in order to accelerate their business. So most companies that are out there raising capital and secondary offerings, it's
Mhm.
because they're still losing money and they need that cash to continue operations, sales and marketing, R&D, whatever it might be. Like DermTech, right? DermTech did an offering in January. A lot of other companies that I own and other investors own have done other secondary offerings over the last 3 or 4 months for the same reasons. Futu didn't do it because they had to. They did it because they wanted to, because they want to be able to offer more margin to their customers. Because if you're able to allow your customers to access more margin, that means that they can trade more. And
Right.
if they trade more, that means more volume, and volume revenues. So,
Mhm.
by doing this debt offering and adding $1.3 billion to their balance sheet, you could see those revenue numbers increase even more. And that would all, because it's a very asset light model, that would lead to even higher EBITDA margins and higher net income margins. And it's not like that $1.3 billion is just getting burned up in operating expenses. I mean, it's not. So Futu's sort of a different story. The stock got pounded yesterday. I thought it might get pounded a little bit more today, because it came out that they priced it at 130. The stock hit 175 2 days ago, so that looked like a pretty significant discount on the pricing. But I think people are starting to understand the story more with Futu, and that this isn't money that's just getting flushed down the toilet on sales and marketing expenses. It's there to to increase revenues.
Right.
So,
Right. And
but so I'm like, and then like the third, so there's the early stage, there's like the mid stage growth, and then there's the later stage growth, which is your Amazons and Facebooks and Nvidias and those types of companies. Like, yeah, I mean, those companies are growing slower. Growth's going to continue to slow for most of them. You're talking low double digits, maybe somewhere between 15 and 30% for most of them. But these companies are obviously more mature, so they're generating more free cash flow. So you do care more about the profit margins or net income margins and the free cash flow and stock buybacks and dividends and all that stuff. So
right.
it's just, those aren't my types of companies. I don't invest. I no longer have interest in the large cap stocks because I'm really focused on trying to find companies that I think can 5x over the next 5 years. And Amazon's not going to 5x, Nvidia's not going to 5x, Tesla's not going to 5x. Still great businesses. I think a lot of investors should still own those companies in your portfolio because they're still going to give you some upside, but they're not going to have the sort of downside that you're going to get in small cap growth. But they're just not stocks that I pay that much attention to because they're not in my portfolio and they won't be anytime soon.
Mm-hmm.
But yeah, my companies, I mean, small cap growth. Yes, this is where you can find those 5 baggers, 10 baggers, 20 baggers, but you're going to get volatility and pullbacks along the way. It's part of the ride. And if you don't want to be on that ride and you can't take the volatility and the pullbacks, then you should not be in small cap growth, or at least you shouldn't have your entire portfolio in small cap growth. I don't mind the volatility. I don't mind the big pullbacks because I know that after these pullbacks are done, you also get those big, jumps to the upside. And, when you're in small cap growth, you have more volatility, but that also creates more opportunity to add value with
Got
trading.
it.
So
Mm-hmm.
when you see what ARK trades around their positions a lot, right? I mean, every single day you see them trimming Square or trimming Roku or trimming Tesla and adding to something else. And then, if Tesla, Roku, and Square drop 10 or 15%, you'll see them start to add back into those positions. That's where they're trading around the volatility. You can do that even more with some of these small cap stocks just because the daily, weekly moves in the prices are even more dramatic.
Got it. Yeah, appreciate that elongated answer. On the matter of the growth stocks, I think that gives a lot of comfort to people who are looking and searching for that bottom, as we've spent about a month and a half now searching for it. Just a couple of quick things before I move on to the next question.
Well, let me. So one more thing on DermTech, and I know this is hard for people, and this is not how everyone can think about investing in small cap growth stocks. So, like back to DermTech, if you are only looking at the current price to sales multiple on DermTech, then yes, it looks expensive. If you think that their current PLA product is going to be successful, if you think Luminate is going to be successful, if you think Carcinome next year is going to be successful, it means that DermTech has the ability to grow those revenues by, let's say, 200 to 300% for the next 3 years, which takes the revenues from like 5 million up to like, 200 million. So if you
right.
do, if you work back, if you're doing like a 3-year DCF model and you're working backwards from those numbers, then you can justify the current price to sales multiple.
Mm-hmm.
But not everybody wants to invest that way. Some people just want to look at price to sales and be like, oh, I'm not paying 45 times sales for any stock under any circumstance. And that's fine. Go buy Apple at, 20 times sales or 10 times. I don't know what the hell Apple sells at,
Right.
but so you need to have a special mindset and a special ability to look long term if you're going to invest in these small cap growth stocks and be willing to pay up for some of these companies that may experience just insane growth over the next few years.
Absolutely. So just a couple of things before I move on to a couple of these other questions. And that is one, this space is being recorded. I've gotten a few DMs. Josh Meltzer is in the audience. You can find him at Josh_Meltzer with a Z underscore, and he's recording this. So I will be uploading this to my YouTube afterwards. Number two, many of my spaces do crash often, but just know that if this one does crash, we'll start it up again. And also thank you, because I have a couple of my friends over at Twitter who are helping me out with that are actually in the crowd listening. So grateful to have y'all here, and for everything that people at Twitter are doing. I'm going to be doing a feedback session with them. And then number three, last thing I'm just going to say before I go on to the next question is, if you are enjoying these type of spaces, I actually, unfortunately right now, there's no way to know exactly when spaces are going to be. So I started a calendar. It is my pinned tweet. If you go to my pinned tweet, you can click on it. It is basically just a calendar that will add when a space is happening. So I do spaces with Jonah and Parrot, Stock Market News, Max, Lamonti, and dozens of other people that I'm trying to bring together in this community to impart value to the rest of them. So if you can check that out and join that, that would be awesome. If you're interested in joining that calendar, or just joining the Wolfpack and joining my page. So Jonah, I'm gonna move on to the next question. I'm gonna give about 3 to 4 minutes for this question because I do want to get through a few, and we have a bit of limited time. So the question is, if you want growth stock exposure, is it best to own the superior company, 2 stocks that are well positioned in the industry, or just an ETF that tracks the industry as a whole? And then they said, for example, would you feel after sufficient due diligence that Nvidia and AMD paired together in a portfolio are appropriate, or just buy the entire Philadelphia semiconductor index or something along those lines?
Yeah, I mean, I think you can be successful doing it either way. I think a lot of it just depends on what kind of investor you are and how much time and effort you want to put into managing your portfolio. I mean, I think there's definitely, um, owning individual stocks requires more due diligence on your behalf rather than just being bullish on an industry. If you're bullish on chips and semiconductors and you really don't want to have to try to figure out which of those companies in that sector is going to be the best performer, then there's nothing wrong with just owning the entire basket, the industry, the sector. There's, like Round Hill, for instance, is an ETF firm that's been rolling out some pretty interesting ETFs for esports and sports betting. And I get that. Like, if you don't want to have to pick between, Barstool and DraftKings and four or five others, you can just own the entire sports betting industry because you think that sports betting is going to be a growth industry for the next 2, 3, 5 years, right? So that is an absolute strategy. And then I think there's another level of people that, whether they're investing full time or it's just a serious hobby for them. If they actually want to parse through the industry and try to pick the winners, then yeah, that's where you would want to own the individual stocks and be able to make a case for owning Penn over DraftKings or vice versa, or in your example, owning NVIDIA over AMD or Intel. It really is more of like an investor by investor thing. Um, eh, you know, Owning an index is, I would say, generally speaking, owning the index is going to give you less upside, but it's going to give you less downside. It's going to be less volatile because you have the diversification of, in most cases, 20 to 30 different stocks in that ETF. So I just think, and there's not, I mean, listen, there were some ETFs last year, some sector ETFs, especially solar, that did insanely well. And I think the solar ETF, or at least some of them, were up well over 100%, maybe even 150 to 200%. But if that's the case, if the entire ETF is up 150% in the year, and that's obviously an extreme example we may never see again, but that also means that there were stocks in that ETF that were up way more than 150%. So a lot of it comes down to how much time and attention you want to put into your portfolio, but also your expertise or experience in picking the right stocks. Because, over the last 5 years, if you picked Intel instead of NVIDIA, you are kicking yourself. So,
Absolutely right. So there could always be that one that pulls ahead, 100%.
oh, for
I
sure.
really like this
Absolutely.
next question, and just I've seen a couple more questions come in on this Google form. Please, there's 270 people I think around in this space. Drop some more questions. It's literally like a one question Google form. You don't have to put in your name or anything unless you want to. So this next question I think is pretty good and honestly pretty relatable for a lot of us, and that is, how do you hedge your small caps during a pullback like this? Many people did not buy in early enough to exit without taking a loss, and they're searching for some way
Right.
to retain value.
Yeah. So, I mean, that's another hard one. I mean, hedging is different for everybody. Not everyone hedges. I usually don't hedge. Um, but I also try not to chase. So, I like, so for Derm Tech, for instance, I mean, I was accumulating Derm Tech a lot in the 40s and 50s. I didn't buy it in the 60s, 70s, and 80s. I waited for it to come back. Now, once it got back into the 50s, I started buying it again. And then I've been catching a falling knife for the last few weeks down into the 30s. So, I wasn't hedged, but I also wasn't chasing. But, either way, I'm still feeling the pain on it. I mean, there are different ways to hedge. I mean, you can short individual stocks. So I've seen people hedge, if they're long Nvidia, they might be short Intel. That's one way to hedge. They might short an index. So this is one way to kind of reduce volatility. But it doesn't always work. If you are long, so there's the IWM, which is the Russell 2000 index, and then there's the IWO, which is the Russell 2000 growth. I would say that most of my stocks are a closer fit to the IWO, the Russell growth. So if I wanted to reduce the volatility in my portfolio, I could be long all of my stocks, but be short the IWO. Now, obviously, if all of my stocks are going up, it means the IWO is probably going down and I'm losing money on that position. But if the reverse happens and all of my stocks start crapping out and the IWO is um, going down, then I'm making money on the short position. Another way to hedge is just buying put options. That's sort of the same way with shorting the index. You're most likely going to. I mean, you can either buy put options on the individual positions in your portfolio, which is basically like just buying insurance in case it crashes, or you can buy put options on one of the indexes. So I prefer not. I don't really hedge in my portfolio, primarily because I say I'm a long-term investor and I'm looking for stocks that can 5x in 5 years, and I have cash coming in every month from several different businesses. So as cash comes in, as my stocks pull back, I will continue to just add to them. Sometimes I'm just like waiting until a stock pulls back to moving average. Sometimes I'm just kind of adding aimlessly to a position. If I have $5,000 come into my account on a Monday, I might just look at my 12 to 15 stocks in my portfolio, which is what I'm at right now, and say, okay, I think these three stocks have gotten beaten up the most in the last week and might present the most upside over the next 2 to 3 months. So I'm going to take this $5,000 and spread it across those three stocks. Like that literally might just that is how I do it most days or some days. And then other days, like a couple days ago, Futu was up 15% on no news. So I sold 20% of my Futu in the 170s and added it to Upstart, Mohawk, and a few others. So
Got it.
it's just, I'm constantly playing that game of, capital allocation. And, like I say, while some stocks are zigging, some stocks are zagging, and sometimes you're pulling money out of the zigging stocks and moving it over to the zagging stocks. Doesn't always work out, but I think more often than not, that for me at least adds alpha to my portfolio.
Definitely. I have a pretty good question for you up next that just came in. Before I do that, I did pin, for anybody that's interested, I pinned the calendar for this Friday. Going to have an amazing space this Friday. Going to have the general manager of Trading Views going to be on that. Going to have both of the hosts, Avi Mash and Anthony Ohayon from Pounding the Table, and a couple of other people. And then next Friday, I'm going to have Luke Jacoby, Hot Stocks Luke from Benzinga is going to be on. Maybe we'll get Jason Raznick. I don't know. See what you can make happen. So make sure that you're checking that out and that you are joining the Wolfpack and following my page. It has been a nice journey. So, Jonah, this one I think is going to be fun because you just came off an interview with the CEO of LifeMD. Can you give us kind of like a 3-minute
Yep.
scoop of what you took away from that interview and your thoughts on the stock?
Yeah. So, I mean, the stock got hammered last week when a short report came out accusing the company or the founders of, misdealings in their prior, business ventures. And I don't think the company has like rebuted that. I mean, they agreed that they made some bad investments and got wrapped up in some bad companies. Um, so LifeMed, I mean, I don't currently have a position in the company. I haven't for the last couple of weeks. It's an interesting stock because I mean they're launching. So they have they have four main products right now. They have their PDF Simplify business, which is growing at like 90 something percent with huge margins. They own 86% of that business. And then they have their Rex MD business, which is their men's healthcare business for erectile dysfunction, all sorts of sexual problems, men's skincare, stuff like that. They have their Shapiro business, which is for men's and women's hair loss. And then they have their new Nava MD business, which is another skincare business. They've licensed that product from another company that apparently spent $50 million developing these products and doing all these clinical trials. And so, I mean, it is a pretty well regarded product line, I suppose. And, they're now taking those three, forget the PDF business, but the three healthcare brands and, kind of creating this telemedicine business out of it. And then later this summer, they're going to be launching what they call kind of a telehealth concierge service where customers can pay, I think it's $50 to $100 a month, and hopefully have 24-hour access to doctors, to ask them anything that they need to. Because, a lot of times it is a pain in the ass to go set up an appointment with your primary care physician just to ask them a few questions. They really don't want to be bothered with you. And then you end up paying a deductible anyways, and you sit in the office for, 30, 40 minutes. Like, it is a pretty big hassle. So, this gives for 30, 40 minutes. Like, it is a pretty big hassle. So this gives consumers or patients the ability to have a tighter connection to a doctor. And I think there is something to be said for people opening up to someone that they've never met, or that they're not actually face to face with. If you're a man talking about sexual problems, erectile dysfunction, it's probably not easy to go to your doctor and have that conversation face to face. It's probably a little bit easier to do it over the phone with sort of a stranger. So I think there are some nice tailwinds right now to telemedicine. And I can see where these brands do have some sticking power. The question is on spend. Their sales and marketing expenses are very high. I asked him about their CAC, which is customer acquisition. He said he couldn't comment. I asked about lifetime value. He said they couldn't comment. So I can't get a good feeling for exactly how much they're paying for a customer, what that customer is worth long term. He said that, he said, just generally speaking, typically they get a payback on that customer acquisition cost within 3 to 4 months. So he wasn't able to give me the exact numbers. 3 to 4 month payback is not bad. I mean, that's decent. It just depends on how much longer you have that customer. I mean, if if you only have the customer for 5 months and the first 4 months are spent, paying back the customer acquisition cost, then I don't like that model very much. But if you have that customer for 12 months or 24 months, then that is a model that has some scale to it. So I mean, I think overall, I mean, especially given now the stock is up 15% today, um, but it's still down. Um, Let me just see. I mean, this was a $33 stock less than 2 months ago, and it opened up today trading at like in the mid sevens. So, I mean, this is one of those stocks that got absolutely hammered. I mean, I'm not going to do the math right now, but it's, probably 75% off the all time highs. A company that's growing revenues at like 125, 130% top line, but you have to worry about the losses, and at some they're probably gonna have to raise more capital at some point, because they're probably not going to be EBITDA break even for at least another year, maybe 2 more years. So what does that dilution look like going forward? How much traction do they get from this new LifeMD business, and then how much traction do they get from uh, the the concierge business? So there's a lot of unknowns. Like, it's definitely an interesting story if people believe in the future of telemedicine matched up with these DTC products as well as prescription products. Then I think LifeMD is an interesting investment.
God, I really like that summary of exactly what they do and breaking down that business model. Is that interview going to be available for people to watch? Is that on your YouTube or something?
Yeah, I mean, I just wrapped up the interview less than an
Right.
hour ago, so it'll get posted to my YouTube
Cool.
probably today or tonight, and then I'll probably shoot it out on Twitter tonight or tomorrow morning.
Awesome. So this next question is bringing it back to one of company that you talk a lot about, and it's a question about Mohawk's balance sheet. And the question was that they found concerning that their current assets less inventory is 43.5 million versus 74.7 million current liabilities. And then they were just also kind of talking about their plus total assets less goodwill equals 79 million. Essentially, they're worried about how large their liabilities are versus their assets. And I just wanted to hear your thoughts on that.
So just off the top of my head, I believe it was like around 115 million in total liabilities. I think that's the number that they refinanced recently at 8% with the warrants. Um, I mean, listen, this is another small cap growth stock that is focused on launching new products and grabbing market share. They're already doing a lot with Amazon. They're now doing stuff with Walmart, and recently they actually got out to Target. So if you go to Target, there are a couple different product lines from Mohawk that you can buy off of Target, Target.com. I don't think they're in Target stores. Um, yeah, I mean, like most of my portfolio companies, I mean, the balance sheets don't look phenomenal. I mean, you're not even like mid cap growth stocks, you typically don't see like, phenomenal balance sheets. I mean, these companies are typically, they're either carrying debt, and in some cases, debt is cheaper than equity. I would prefer companies, and most growth companies, I would prefer them to grow with debt versus equity. But the problem is they can't. I mean, most of the time, if you're a small cap growth stock that is still in the red, for EBITDA earnings, etc., you have a hard time accessing debt. And to the extent that you can, you end up paying higher rates, which is what we saw from Mohawk. I mean, given the low interest rate environment we're in right now, to have to pay 8% on your debt plus warrants is not cheap. But if that's what you need to fuel your growth and to continue on your acquisition strategy, then I think it's justifiable. I mean, I sort of call Mohawk a publicly traded private equity fund or group that's basically rolling up e-commerce brands, and that's sort of exactly what they are. I mean, they have 12 or 13 brands right now. I think organic growth on those brands can probably stay around 40% going forward. And then I think some of the other growth is going to come from the M&A, buying a lot. And I just watched another interview today with the CEO of Mohawk, and he did a really nice job explaining it. There are, thousands and thousands of these e-commerce brands that were started in the last decade that have, one or two great products, great reviews and ratings across the marketplaces. Manufacturing is set up, and these are pretty asset-light businesses, high margin, generating a lot of free cash flow. But those owners are ready to get out of the business and move on to something else, and that's where Mohawk can swoop in and buy these businesses, or more or less just buy the assets and the revenues and the ratings, and get rid of the people and a lot of the fixed costs, and even some of the variable costs associated with that company, to make that, to drop more of that revenue down to the bottom line. So, if the CEO says that they have, a ton of accretive deals in the pipeline, and that they needed to lock in this debt in order to get back to that M&A strategy, then I'm going to trust him. I mean, I don't know the company, the balance sheet, as well as the CEO does, or the CFO. So at some point, you just have to trust the management teams that run these companies to make the best decisions. And I mean, I'm still bullish on Mohawk because I'm still bullish on e-commerce. We saw big acceleration in e-commerce during the pandemic, and I don't think those trends are going away anytime soon. I mean, I think Amazon's going to continue to grow. Walmart's going to keep growing. Target's going to keep growing. Mohawk is already expanding to Europe, and I think they're going to have other expansion opportunities, perhaps in South America or Asia, with their existing brands or new brands. So, I mean, this is a market cap that fell as low as, I think, under $700 million yesterday at the lows. And they've already given guidance this year of 360 million of top line revenue. And of course, that could be conservative, and that doesn't include any more M&A. So, I mean, the stock was trading at less than 2 times sales, with gross margins in the mid 40s and somewhere around 31 million of expected EBITDA this year. So I think the stock was trading at like 22 times EBITDA with the 100% top line growth. So I'm still bullish on the company. I think the price yesterday was a huge buying opportunity. I'm just sad that I didn't have any cash lying around to buy more.
Got it. Yeah, appreciate that. All right, we have a few minutes left. I have several questions that are here, so we might have to do this again, to be honest, to get through all these questions. But I thought that this question came in and it was pretty fun. And if you can't answer it, that's fine. But if you, I don't think you are you allowed to purchase IPOE?
No.
Okay, if you were allowed, would you purchase it? Or can I not ask that?
Yeah,
All
I'm
right,
not even
fair
allowed to
enough. We'll move
comment.
by that. Okay, so my other question was, I posted last.
I mean, I will say this. I mean, I do think Social Capital is a very strong business with a very strong brand. I think Anthony Noto is a great CEO. And I do think the company has a very, very bright future. I mean, it's one of the few fintechs that I would definitely want to own if I could own it. And that's sort of why I owned
Mhm.
Moneyline for a while. Is Square's too big for me. I can't own IPOE, and I was looking for another great fintech company that had all these different businesses kind of rolled up into one. And Moneyline seemed like it could be one of those companies that grew into a 15-20 billion dollar company someday.
Right.
So those are two of my favorite fintechs right now. Social Capital, or it will be Social Capital whenever they finish the SPAC merger, and then Money Lion, because they're all doing the same things. They're all, they're offering, online savings and checkings, investments, crypto, stock trading, lending, like, basically every financial service you need all in
Right,
one.
right, exactly. Okay, so I guess just to wrap this one up, and then, like I said, we got a bunch more questions for the next one. Is I posted last night a tweet asking for people to share their top three largest positions.
I mean, I could keep on going. I mean, those are all great businesses that are still growing exceptionally well, but I don't know if they can 5x over the next 5 years. And if I'm really focused on these companies under 10 billion, then I had to say goodbye to a lot of those companies. Pinterest was one of them. But I mean, if you look at the numbers on Pinterest, I mean, I think I would rather own Pinterest um, than Twitter, than Facebook, than Snapchat. I think Pinterest, I mean, they have a massive community of users, and they seem to be doing a great job with monetization. And that monetization, feeds nicely into e-commerce. I believe they're one of the primary sources of traffic for Etsy. So, I mean, there's a lot of, I mean, if I was still investing in large caps and Pinterest pulled back, I would absolutely try to add to it.
Appreciate that. All right.
I mean, and
Yeah.
this is where like I think if people want to be in these small cap growth stocks because they provide more upside, I would agree with that. I also think there's a strategy that you'd want to pair these small cap growth stocks up with some of these large cap growth stocks, because even though I think the large cap growth stocks might have a little bit less upside, they also have less downside. They're going to be less volatile. They're stronger companies, stronger balance sheets, cheaper access to capital. Like, I'm a little insane with my portfolio and what I own. But if you want to pick out three, four, five, six small cap growth stocks that you really love, then add those to your portfolio, and then pair those up with five, six, seven larger companies that you're also excited about. The CrowdStrikes, the Pelotons, the Teslas, etc. I don't think everyone, unless you really have the stomach for it, should be 100% small cap growth.
Right. It's great to have a mix, and that's a lot of what I saw when people were posting. Was they often had a really powerful growth stock in there. Maybe it's SE, maybe it's something else, and then they were holding something of Apple or Amazon or one of those other ones where there's a lot more balance. So, Jonah, I know that you have a busy schedule today. Is that all the time that you have today?
I could do like another five
Okay,
minutes.
then let's do it. A couple of just other stocks I'm gonna throw out to you. If you have thoughts, you can answer them. If you don't, no worries. ACUIF. Any thoughts?
I still haven't looked into it, so no, I don't.
All right, no worries on that. I have a couple other questions. So Chicky tweets, thanks for your questions. So have you done any research on INTZ after their short report?
Yep. Yeah. I'm actually glad that one came up. Yep. So last last Tuesday, I did a write up on Intrusion, ticker symbol INTZ. So the stock came across my DMs actually like a month ago. So I spent a couple weeks looking into the company. I talked to a couple employees. I talked to investor relations. I talked to the analyst that was covering the stock, this guy Scott Buck from HC Wainwright. They all had positive things to say, of course. Um, and then, so I started doing my write up, and my write up went out last Tuesday afternoon. And I felt really good about it because Tuesday morning, the company put out a press release talking about a couple new hires, but most importantly was the 50,000 seats that are on Shield. So Intrusion's been around for 30 years. The company was started by a guy named Ward Paxton. He died a couple years ago. They brought in an interim CEO who really just kept the business alive, and that business was primarily doing cybersecurity work for the DoD, which is Department of Defense. And then the company decided to bring in this guy, Jack Blunt, who was kind of a turnaround specialist, but a lot of industry experience. They brought in Jack, and Jack looked at the company and all the data and all the software and AI that they developed, and said, "Okay, let's take what we have right now that we're doing what we're doing for the DoD. Let's package it up into a new product called Shield, and let's offer Shield to enterprise customers." And that's the story that I really got excited about. And because all of the data and the beta testing that they did looked very impressive. And I could see where enterprises would want this additional level of protection across their network, especially for employees now that are working remote using VPN. And those employees would still be protected with Shield. And last Tuesday morning, the company did a press release saying we now have 50,000 seats committed to Shield. Now, they're not all activated yet, but those 50,000 seats should be activated shortly, maybe the next couple months. But IR confirmed with me after the short report came out. So Tuesday morning, the press release came out. Tuesday afternoon, my write up went out, and then Wednesday morning, like the worst timing ever, the short report came out from some garbage firm called White Diamond that I'd never heard of before, and they put all sorts of crap in there that I knew was not true. They tried to say that the Paxton family was unloading all their shares, which is not true. It is scheduled selling from the family whose father died or relative died. They inherited all of his stock. They no longer have any connection to the company. Of course, they would be unloading some shares. I mean, that's just normal. They also said that the former CEO resigned because he was scared to death. And I talked to IR, and he's like, "That's ridiculous." Like, he told me that he was scared to be the CEO or the CFO when the company was bringing a new CEO and launching new products for the enterprise, because he just didn't have any experience being a CEO, CFO in those conditions, and he was only an interim CFO to begin with. So, once again, the short reports love to, kind of manipulate the truth or just completely, feed outright lies. What I don't like is that management has not come out and given a strong statement or rebuttal. They did post something on the website that basically said, I forget what it said. I mean, it was a very, very short statement. I want to see something a little bit longer, something to the extent of what LifeMD did, because LifeMD also was a victim of a short report last week, but they came out last Friday with a very bold statement on their website. I would like to see Intrusion do that. But I mean, to be honest, yes, the stock has gotten absolutely cremated over the last week. However, if management is being honest, if the IR is being honest, and those 50,000 seats are actually real, then this sell off is completely unjustified, because those 50,000 seats at $20 per seat per month is $12 million of revenue on top of the DoD revenue. And that gets you pretty close to $20 million in ARR. And this company is not being valued as a company doing 20 million in ARR. On top of that, IR also shared with me that they have multiple Fortune 500 companies that are currently doing beta testing with the Shield product, including 2 Fortune 100 companies that would both be getting at least 50 to 100,000 seats each. So, I mean, obviously that's, there's no guarantee that those beta customers turn into clients. There's no guarantee on what the seat counts might be. But by all indications, it seems like the company is doing the right things. They're just a victim of a short attack. So, once again, I mean, these small cap stocks, they are easy prey for the shorts. They're easy prey for the short reports, and there's very little that these companies can do, to sort of save themselves in the short term. The markets are not efficient in the short term. That is like a stupid saying that people like to use. Markets are efficient. Yeah, over the long term, as fundamentals get to play out. In the short term, markets can be very, very inefficient. I mean, just look at the markets the last 2 days, where stocks are down 8% yesterday and then up 10% today. I mean, what's efficient
Did you
about that?
did you
Nothing.
see the did you
So
see the lawsuit that came out about an hour ago? Hour and a half?
those are all
Yeah.
bullshit. All bullshit. Go look at any stock that's ever had a short report against them, or any stock that's ever dropped more than 15 or 20% in a day. There are dozens of these predatory scumbag law firms that will try to bring in victims or shareholders that own the stock in order to form a class action lawsuit and then get paid off by the company. It happens all the time. I mean, go back to last March, where stocks were, a lot of stocks were down 30, 40%. There are dozens and dozens of these fake lawsuits out there. So yeah, they are ridiculous.
Absolutely. I see that on here. So that'd be an interesting thing to look into. So Jonah, I think a great way to end off your time would be, I'm going to give a quick shout out and say that I'm long Celsius. because I'm trying to get them to sponsor my Twitter Spaces. So this is recorded. Celsius, I like your product. Sponsor my Twitter Spaces. Long CELH. I'm currently up.
I'm long
I'm
too. It's one of my top
I'm making
positions.
money on the stock. It's up 1,226% this year. They recovered massively. They were
No, not this.
or
Maybe in the
one
last
year,
12
yeah, to
months.
365 days. They recovered massively from when they bottomed down to 42. They're all the way back up to 57. So Jonah, give us the 1-2 punch on CELH for I guess the closing.
Yeah, I mean, so they reported huge Q3 numbers, 80% growth, and then I think people were looking for something comparable in Q4, and when numbers only came in or growth only came in at 54%, I think investors were disappointed, so they sold off the stock like 20 or 25%. But I just think a lot of them missed the part of the story where the company is in the process of switching from DTR, which is direct to retailer, over to DSD, which is direct store delivery. So over the last 6 months, the company has pivoted from, instead of shipping their product into the retailer's distribution centers, and then that product has to get shipped to the store, and then an employee has to stock it. DSD means they now work with 150 regional partners that ship the product, take the product themselves on their own trucks to the store and stock the shelves themselves and then they're responsible for making sure that those shelves continue to be stocked. So if you're a regional DSD player, you're covering, certain grocery stores, convenience stores. You're at those stores every day or every other day, stocking the shelves with all of the different products that you're covering. So that is a huge move by the company. On top of that, they already announced that they hit 82,000 stores at the end of 2020. I think they have a chance of getting to 100,000 stores by the end of this year. They have 1,400 branded coolers going into top locations. Those branded coolers are already creating a massive sales velocity, up to 100% growth compared to non-branded coolers or the product getting stocked on shelves warm, because a large percentage of not just soft drinks and waters, but especially energy drinks are grab and go, and people don't want to grab a warm can off of a shelf and then drink it. So the fact that these branded coolers would be in high traffic stores in high traffic areas and kept cold all the time with multiple, with the large selection of flavors, that's a big move. So Celsius is doing everything right, and then throw on top of that the opening, the reopening of gyms and fitness centers and spas and studios, and then of course they're still crushing it on Amazon. Like this is everyone likes to call C Limited the three-headed monster. Celsius is like a mini three-headed monster with e-commerce, gyms, and then retail and convenience.
I know Parrot loves that SE shout out. Hopefully, I'll get him up here. Okay, perfect. I'm gonna take that recording and clip that and send that over to Celsius HQ, so we can get this ball rolling. I know I have Jonah's backing. All right, Jonah, you have another meeting at 12:45, right?
Yeah, technically starts at 1, but we have to do like testing at 12:45. It's for Finimize. I don't know if you guys are familiar with
Yeah,
the
they
Finimize
sponsored they
platform.
sponsored Market Madness.
Oh, cool. Yeah. So it's with them.
Yeah. Shout out to my sponsors. This isn't really a Market Madness. This is more of like a Market Madness pod, I guess. Maybe I'll put this on my uh Spotify, but shout out to my sponsors: TradingView, Seeking Alpha, Finimize, RetroSend, and SocialSentiment.io. Those are the sponsors for Market Madness, which, by the way, we're coming up to the championship. Jonah, I'll just ask you this last thing. Our championship is an interesting pair of contenders. There are two left. Bitcoin lost in the final four. So it lost to PLTR, to Palantir. So the championship is going to be hosted on Monday. It's going to start at noon and it's going to run for 48 hours. It's going to be PLTR being pulled against Buzz. The Buzz ETF
Oh my
went all the way
God.
to the championship.
Really?
Yes, the Buzz beat Facebook in
Do
the final
people
four.
do people even know what's in Buzz? Like Buzz is not that exciting. I was all pumped up for Buzz because I thought it was gonna be like this really interesting like momentum ETF with all the hot stocks in it from across all these social media sites. It's a lot of like it's way more large cap stocks than I was expecting. It's like Apple and Boeing and some other big ones. So I'm going with Palantir.
Okay, ladies and gentlemen, you heard it here. Jonah's going with Palantir. Maybe we'll get a little retweet or something on that. poll once that's up. Very cool. All right, Jonah, I'm gonna let you do your thing, but I would love to do this again maybe next week because we have so many questions.
Anytime, man.
Perfect, perfect.
Anytime. It's especially on green days. It's way, as you can tell, I'm in a much better mood today than I was yesterday.
Yeah, well, you know what? We'll have to see if this happens. It's if it's a green day, maybe if we do this next Wednesday morning, maybe we'll just keep it up, keep the
For
green days
real.
rolling. Yeah, I'm
Absolutely. Let's keep doing it. We'll move these markets higher by ourselves if we
I'm
have
doing
to.
my best. Twitter Spaces, market manipulation. I don't know, but it is what it is. All right. So I have a couple of. I'm not going to end the space here, Jonah. I know if you have to hop out, that's fine. I have another like 15 minutes until my next call, so I might bring up like Parrot or Uncommon or Max if any of them are free to speak. If anyone of my usual speakers just wants to request, I'd love to bring you up here and just chat for a few minutes.
Okay. I'm out of here. Thanks, guys. Thanks for tuning in. Appreciate it. Talk to
All
you
right.
soon.
Thank you so much for your time, Jonah. Good luck with your meeting. All right. I got several of my speakers that I usually have up here. So I'm going to invite a couple of them up to speak. So stick around for a minute if you're enjoying the space because these are some head honchos up here and maybe one of them will accept and they'll chat with me. So I'm just inviting several of them right now. I mean, you could also request if you're interested. Um, that is kind of how it's going. So I see a few coming up here.